Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. Thank you for joining to our episode of Through the Noise. My name is Heung, a senior investment strategist in the CIO office, and today I'm very happy to be joined by Manpreet Gill, our CIO in the AMEE region, and we will be talking about our second quarter outlook. Thank you, Manpreet, for joining. So, over the last 2 weeks since the Middle East conflict has started, now can you tell us a little bit more about how you're thinking about the scenario has evolved? Definitely, given the events that you are thinking about, and also the risks associated with it.
Hi, Ray. Thanks for having me on. In the current environment, we still think that a scenario-based approach makes a lot of sense, given this is a fluid situation still and something we have to monitor quite closely. Now, given recent events, we still believe our base case that supply disruptions that are causing high oil prices only last another 3 to 4 weeks. We assign about a 70% chance to this base case outcome, and the reason we hold this view is that other than the level of oil prices themselves, how long oil prices stay at high levels is actually quite critical. That's an important distinction over level of prices because the impact on global inflation is likely to be fleeting if price gains do not sustain beyond a few weeks. That scenario, of course, would allow us a return to our baseline soft landing macro scenario, which, of course, would be supported by Fed rate cuts in the second half of 2026. So that remains our base case scenario at this point in time. Having said that, a downside scenario where oil prices stay high for an extended multi-month period is likely to be more damaging for inflation because it would limit the Fed's ability to cut rates. And we assign about a 30% chance to this downside scenario at this point in time. Now, that higher inflation expectations would, of course, risk a knock-on impact on equity and bond markets and may, need us to potentially revisit some of our asset class views. At the moment, we do view the likelihood of this scenario as relatively low, but of course, the rapidly evolving situation warrants close monitoring in the coming days and weeks. Now, amid this focus on the Middle East conflict itself, we shouldn't lose sight of a second risk, which we are monitoring. We have the jitters in the private credit market, which in our mind is another risk to monitor. Now, here, near-term negativity, including some gating events, we think are possible. Having said that, we do see value in riding out short-term worries as long as exposure is focused on the highest quality managers.
I see. Thank you, Manpreet. That definitely helped explaining why you remain constructive of equities on longer term. How are you considering the difference in terms of the regional impact?
Well, when it comes to regional equity markets, we maintain our preference for US and Asia ex-Japan equities. Now, when it comes to the US, in our base case scenario that we just described, we expect US equities to outperform. And this view that this outperformance will be driven mainly because of strong earnings growth, with the market ultimately looking through near-term oil price-driven volatility. And against this view, we believe any pullbacks in the coming weeks would represent buying opportunities. Now, within this, the U.S. technology sector's year-to-date underperformance is an area we see an opportunity to add where appropriate. The sector continues to deliver strong earnings growth, which we believe will ultimately drive performance, particularly for the semiconductor and internet subsectors, which we prefer over software. That said, we would avoid excessive sector concentration at this point in time. So looking beyond the technology sector alone, we also see opportunities in the U.S. utilities and healthcare sectors, where we think there are attractive opportunities after recent pullbacks. So that's when it comes to the US. On Asian equities, we do recognize that they may remain under pressure for now if the conflict extends the rise in oil prices. However, in a base case scenario that this rise in oil prices only lasts a few weeks, we would view any further weakness in the coming weeks as an attractive opportunity to add to Asia ex-Japan equities. Now, within Asia, we remain overweight Indian equities. The market is clearly sensitive to oil prices, but given our discussion of the base case, we do see any further pullback in the coming weeks as an attractive buying opportunity, given our long-term focus on the rebound in corporate earnings growth and the cumulative impact of past policy stimulus. Within Asia, we're also similarly overweight Chinese equities and expect outperformance to be led by strong technology sector earnings. And outside Asia, ex-Japan, I'd also wanted to highlight that we have closed our underweight on Japanese equities, bringing them up to a core holding because we expect the market's performance to resume once peak oil price pressures are behind us.
Thank you, Manpreet, again. Let's move to bonds, right? Yields have also been pushing slightly higher at the rate cuts price out right now. Do you see an opportunity here?
We do. Because when you consider the rise in U.S. government bond yields, they do appear to have been driven by the risk to rising inflation from oil prices. But going back to our scenario analysis again, right? In our base case scenario, we would see the rise in bond yields as an opportunity to lock in yields. So looking at rebounds above 4.25% on the 10-year benchmark yield, for example. Now, we do increasingly prefer to take this exposure to lock in yields via corporate bonds, given what we've witnessed in terms of the rise in corporate bond yield premiums in recent weeks. And we're now overweight developed market high yield bonds and have upgraded developed market investment grade bonds to a core holding, high yield, of course, to an overweight. And we're funding that through an underweight in developed market investment grade government bonds. That's on the corporate bond side, but when it comes to emerging market bonds, both US dollar and local currency, our overweights to both these asset classes remain unchanged. Emerging market US dollar bonds offer a good balance between commodity exporters and importers, while local currency bonds should benefit from renewed weakness in the US dollar over the coming months.
Thank you. Now, moving on a little bit to the US dollar, essentially a lot of people see it as a safe haven, right? So is the dollar surge an opportunity to add to the weak dollar FX trade?
Yes, we would look at it that way because we've seen some dollar strength emerge in recent weeks, and that's unsurprising given the U.S. is not as dependent on energy imports as many emerging markets are. So we've seen the dollar behave as a safe haven, and the dollar index or the DXY index test the key 100 level. And just as an aside, these dollar gains most probably partly explain gold's inability to rise in the last few weeks as well. But once again, going back to a base case scenario, if this rise in energy prices is indeed only weeks long, then that's a scenario where we would expect US dollar weakness to resume over the rest of the year as the Fed is able to cut rates in the second half. And that's why we see current levels as an opportunity to rebuild weak dollar views. Now, this includes several ways to achieve that outside of FX markets. Our overweight to gold, our preference for Asian equities, our preference for EM bonds. These are all ways to express or rebuild weak dollar views. But within currency markets as well, we do see this dollar rebound as an opportunity to diversify currency exposure. And this includes both reducing concentration in carry trade currency exposure, such as the Swiss franc, but also potentially adding to currencies like the Australian dollar, which are strengthening given their own domestic inflation pressures and hawkish central banks.
I see. Thank you, Manpreet. Maybe let me recap. There are three things that we want to point out this time around. Number one, I guess, is the duration of the conflict is actually a key macro risk driver. Our base case, which is assuming 70% of the chances that the oil prices spikes only last for a few more weeks, and therefore keeping inflation effects temporary and preserving a second half 2026 Fed rate cut and soft landing outlook. Number two is stay constructive on risk assets with selective regional and sector positioning, especially if we talk about this U.S. equity remain an overweight, with the pullbacks seen as an opportunity to buy. Technology sector, semiconductor and internet included. Asia may face near-term pressure from oil, but any further weaknesses is viewed as an opportunity, particularly also including India and China. Thirdly, high yields and a stronger US dollar actually create tactical opportunity for investors. The rise in the US yield is actually seen as an attractive for long-term locking of income, with a preference for DM high yield and IG corporate bonds over the government bonds. And the reason US dollar safe haven strength is actually viewed as an opportunity to rebuild weaker US dollar positions, including gold and EM assets. Now, that's all the time we have for today. Thank you for listening in, and please do refer to our Global Market Outlook, which is published today for more information. We will see you in the next episode of Through the Noise. Bye now.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.